Hello and welcome to another deep dive video. Today we're taking an in-depth look at JPMorgan, ticker symbol JPM. We dive into the financial metrics, assess the company's growth, and ultimately try to find its fair buy price. JPMorgan operates in the banking sector and is well known for being the biggest bank in the world. The stock is priced at $212 with a market cap of 607 billion. Now let's dive into some key valuation metrics. The price to earnings ratio stands at 11.9 and the price to cash flow ratio is not applicable. The median price to earnings over the past 10 years was 11.6. Over the past 5 years, the company's revenue has grown by 32.2%. Its bottom line has increased by 36%. In terms of earnings per share, there has been a growth of 51.4%. Then, notably, the number of common shares outstanding is 2.91 billion, a minus 9.8% change. Now, let's assess the company's liquidity and solvency. The interest coverage ratio is 2.21, which for banks is pretty good. The quick ratio, a measure of the company's short-term liquidity, is not applicable in the case of banks. Additionally, the total debt to equity ratio is 2.43, and the total debt to equity ratio is also 2.43, which for a bank is a very low debt load, and that is a quite healthy sign. Shifting to the cash flow statement, cash flow operations stands at 13 billion, reflecting a growth of 270%. But it should be noted that it's not really a useful metric for banks. Net income is much more important. Cash flow investing activities is 67.6 billion with a minus 240% change, while financing activities are at minus 25.5 billion, showing a minus 177.5% change over the same period. CapEx is not really applicable, apart from a few small acquisitions, and free cash flow is not applicable either. Moving forward, let's look at the return metrics to see how the company is utilizing its resources. The return on equity is 15.8%, which is very good. The return on investment is 9.6%. The return on assets is 1.3%. The return on invested capital is not applicable. Finally, let's find the settlement for buy price. The first method is usually a DCF analysis, but cash flow is not applicable, so we won't calculate it. Secondly, using a multiple valuation of 15 times earnings, we get a fair value of $278. And finally, the analyst price target is $225.6. Putting it all together, we get an intrinsic value of $251.8. And using a 15% margin of safety, we get an acceptable buy price of $214, suggesting that the stock at the current levels is undervalued. To wrap up my analysis, I rate JP Morgan as a hold. Now, this is not because I believe the bank is not well run. I believe it's very well run. But I believe that the fact that interest rates are going to drop, and also I do not, and also because the fact that price to earnings is not really a great way to value a bank. I believe that the intrinsic value, which I've calculated, or the acceptable buy price, is not really low enough yet. So for now, it's just a hold. As I mentioned, the interest rates dropping they will drop their net income, their net revenue. So these calculations are not really applicable 2 years from now, 3 years from now. Of course, do your own due diligence, make up your own opinions about the interest rates, about how they affect big banks. But I believe that long term, the interest rates dropping combined with the fact that the US debt is soaring, so um and also the cost of living crisis, people will have less money, so there's really much less space to lend out, much less space to move for big banks. So I don't really believe there's much space to grow. The most used method to value big banks is book value, but the problem with book value is that you can't really estimate it in the future. You can try to do it based on the past, but it's pretty complicated. The big banks is not. It's not really when running a bank. It's not really about the size of the bank, but really how well you allocate the capital itself. It's mostly a game of numbers, not really a game of making smart investments in the sense that they're a normal company doing capex. No, it's really just a game of numbers. And the more efficient you are, the better you are with numbers. Like Jamie Dimon, the better you can grow your bank. Now, I believe that Jamie Dimon still is a great CEO, of course, a great company, running a great company, but hard for me to see the opportunity here. Of course, as I've always repeated, you should do your own due diligence, form your own opinions, because that is why the stock market is for everyone. You can invest based on, I don't know, you have an idea and invest based on it. But of course, there must be a base to every idea, there must be a fundamental truth to every idea, fundamental reality. And that reality is formed by the balance sheet, the income statement, and the cash flow statement. Now, as for when I think it would be a buy, I think personally it's below 190. I think 190, 185 it would be a buy. Now, thank you for watching. If you found this video helpful, please like and subscribe for more development analysis. See you in the next video. Bye.